Welcome back to the deep dive. If you trade, or maybe even just follow the financial markets, you definitely know what a candlestick chart looks like.
Right, the standard high-low, open, close.
Exactly. But here's the thing, right? That candle, it's really just the final score of the game.
Uh-huh. It tells you what happened, but not how.
Precisely. The real game, the actual tussle for price control, that's happening underneath. It's happening in this area that professional traders call order flow.
That's the key.
So today, we're diving deeper than just those simple price pictures. We're going to try and peer into that live, second-by-second flow of actual buy and sell orders hitting the market.
The real transactions.
Yeah, and our goal here is really to give you a kind of shortcut, a way to understand how the pros are trying to figure out intent.
Trying to infer who's really winning that tug of war.
In real time, yeah. Based on the urgency you see, not just where the price ended up.
Yeah, and that's what order flow really is, isn't it? It's about transparency. It's that live stream showing not just that a trade occurred, but the crucial part, how it occurred.
Right.
Was it someone aggressively buying, lifting the offer, showing they needed in, or was it an aggressive seller hitting the bid, showing they needed out urgently?
It's the difference between just looking at a map versus seeing the actual troop movements on the battlefield, deciding who holds the ground.
That's a good analogy.
Mm-hmm.
And our mission here, for you listening, is to help you quickly grasp these core ideas. We want to focus on the specific signals the pros really watch.
Not get lost in the weeds with 50 indicators.
Exactly. We're hunting for evidence, clues about institutional intent, because frankly, that's the most valuable thing order flow can give you.
Okay. So let's unpack this then, because if we get the basic terms wrong, none of the signals will make any sense later.
Foundational stuff.
It seems like it really boils down to just two main types of players in the market, right? The aggressor and the passive participant.
That's the fundamental split.
The aggressor.
They are the initiator. They're urgent.
I need in now.
Pretty much. I need to buy or sell right now, whatever it costs. So they use a market order. And importantly, that market order consumes liquidity. It takes it off the book.
Okay. So they're the ones actually driving the price changes we see second to second.
They provide the force, yeah.
Mm-hmm.
When you see big aggressive volume print, you know someone, somewhere, is highly motivated.
Got it. And then the passive player, they're using limit orders, you said.
Right. They're the ones sitting patiently on the bid or the ask, essentially providing the liquidity that the aggressors consume.
They're the supply and demand just waiting there.
Waiting to be filled, yes. They represent the resting supply and demand. Now, you asked if they're truly passive.
Yeah, because passive sounds weak, but maybe they're the smart money, just waiting with deep pockets.
That's exactly the strategic element. Often, that passive liquidity is the large institution. They're willing to sit there and absorb a huge amount of aggressive flow without budging. So their presence, or importantly, their absence when they pull their orders, that often dictates how far the aggressors can actually push the price.
So when an aggressor hits a passive limit order, liquidity gets removed. And that's the constant fight we're trying to watch.
That's the core dynamic. Urgency versus patience. Aggression versus absorption.
Okay, urgency versus patience. I like that. But how do we actually see this? It sounds kind of invisible. What tools turn this raw data into something actionable, something beyond just the candle?
Right. You need specific lenses. The most basic is the tape, or you'll hear it called time and sales.
The ticker tape.
Essentially, yeah.
Yeah.
It's the live stream of every single transaction.
Mm-hmm.
It shows the price, the size, the exchange it happened on, and critically, whether that trade lifted the ask, aggressive buy, or hit the bid, aggressive sell.
Okay, so it's like the literal receipt for every trade.
Exactly. It's the raw feed.
But if the tape is just this relentless stream of numbers flying by, I mean, how does anyone actually spot the important stuff? The big orders or like a defensive line building up?
Yeah, the tape alone can be overwhelming. That's why you need the next layer, level 2 data or the DOM depth of market.
DOM. Okay.
This shows you the passive side. It's the live stack of all those limit orders sitting at every different price level, both above and below the current price.
Ah, so this is the visible liquidity pool, the patience we talked about, waiting for the aggressors.
Precisely. And tools like Bookmap take this DOM data and often visualize it as a heat map. Makes it really easy to visually spot where those big stacks of resting orders, those potential defensive lines are sitting.
Okay, tip for the action, DOM for the resting defense. Then you mentioned footprint charts, especially for futures. Why is seeing volume inside the bar such a big deal?
Well, it's revolutionary because it lets you see the battle within each bar at each price. Instead of just seeing price move from, say, 100 to 101,
Yeah.
the footprint tells you, okay, at $100.50 specifically, There are maybe 500 contracts bought aggressively, but only 10 sold aggressively. It dissects the bar, price by price, showing the aggressive buy volume versus the aggressive sell volume.
Wow, okay, so it's calculating that difference at each price.
Yes, and that specific volume difference, aggressive buys minus aggressive sells at a price, is often called delta volume.
Delta, got it.
And that naturally leads us to probably the ultimate summary metric for this urgency: cumulative delta.
Cumulative, meaning added up over time.
Exactly. It's a running total for the session or the bar or whatever period you choose of total aggressive buy volume minus total aggressive sell volume. If that line is trending upwards, aggressive buying is generally winning the fight over that period.
So it's like a thermometer for buying versus selling pressure. Tells you if the urgency is genuinely building or if it's starting to fade.
Perfectly put. It measures the net aggression.
All right. We have the vocabulary aggressor, passive. We have the tools tape, DOM, footprint, delta. Now let's get to the payoff. What are the signals? Once you have this data flowing, what are like the 2 or 3 most powerful patterns that scream to a pro what might happen next?
Okay, number one, absolutely critical, is absorption.
Absorption sounds defensive.
It is the key defensive signal. It's what happens when you see huge, aggressive market orders. Big prints on the tape hitting the bid or lifting the offer, but the price just doesn't move through that level.
Why not?
Because massive passive limit orders sitting there on the DOM just soak it all up. They absorb the entire aggressive flow.
Huh. So it sounds like a trap for the aggressors.
As it often is, yes.
Yeah.
Absorption basically shows you where the big players are drawing their line in the sand. They're defending a level.
Give me an example.
Okay, imagine you see a huge print, maybe 1,000, 2,000 contracts, hit the bid, aggressive selling. But the price barely ticks down or it holds firm right there.
Okay.
That signals that large passive buyers are just sitting there absorbing all that selling pressure. It strongly suggests the sellers might be getting exhausted. And if that absorption is then followed by even a few decent-sized aggressive buy prints.
Confirming the defense worked.
Exactly. It flags a high probability reversal, or at least a significant bounce.
Yeah.
You've seen the defense hold.
Okay, absorption is the big defense. What about offense? What happens when there's just no defense? Price slices through.
Right. That takes us to the opposite scenario, which is often called a sweep. Pure momentum.
Sweeps, like sweeping liquidity.
Precisely. Sweepers are often seen as a rapid-fire sequence of market orders. Sometimes they're small individually, but they come fast, one after another, just eating through multiple price levels very quickly.
So it's just pure aggression hunting for the next available price.
Yes, looking for liquidity. The visual signal here is key. You'll see on the tape a cluster of aggressive buys lifting offer after offer or sells hitting bid after bid.
Yeah.
Very fast prints, and the price moves quickly through areas where the DOM shows thin liquidity.
Like those low volume nodes, the LVNs you see on a volume profile.
Exactly. If you see sweeps slicing through an LVN, that's a strong signal. It confirms momentum is accelerating, and the path of least resistance is in that direction. It's a continuation signal.
Absorption for defense, sweeps for offense. What else? You mentioned a warning sign earlier?
Yes, the market failure signal, arguably one of the most powerful. Delta divergence.
Divergence, meaning price and delta are doing different things.
Exactly. This is where the aggressive action, measured by cumulative delta, stops confirming the price action.
How does that look?
The classic pattern is price pushes up and makes a new high for the session, let's say. But the cumulative delta line fails to make a new high alongside it.
So less buying urgency on that last push higher.
Precisely. It means the aggressive buying pressure needed to achieve that new price high is actually weaker than it was on the previous high. The enthusiasm is fading.
So the engine's sputtering even if the car is still rolling uphill slightly.
Perfect analogy. That divergence signals exhaustion. It strongly implies an upcoming reversal or at least a significant pullback is likely. It's a major warning flag that the move is running out of steam. Same logic applies in reverse for new lows.
Wow, okay. That feels really important. Now, we also have to touch on the more sophisticated side of this. Not every buy is truly bullish, right? You mentioned disguise selling. How does that work? It sounds backward.
It does feel counterintuitive, but it happens. Imagine you see a lot of aggressive market buys lighting up the tape, lifting the ask. Normally, you'd expect price to rally hard, right?
Yeah.
But instead, the price just kind of churns or maybe even slowly ticks lower.
That's weird. Why?
It could suggest that large players who want to sell, maybe short sellers, are passively offering huge size on the ask. The aggressive retail buyers come in, lift the ask, and unknowingly fill those large hidden sell orders.
So the visible buys are just cover?
They can be. The large seller is using the incoming buy flow to mask their own selling, absorbing the bids without having to hit the bid themselves aggressively. When you see this kind of confusing flow, lots of buying prints, but price failing to follow through the general rule is trust the price direction.
Meaning, if price is still grinding lower despite the buy prints, favor the downside.
Correct. Because that hidden passive selling pressure is likely overwhelming the visible aggressive buying. Respect the prevailing price trend in those confusing moments. If persistent hitting on one side fails to move price that way, trust the way price is actually moving.
Okay, that's a subtle but crucial point. So we've got the theory, the tools, the key signals, absorption, sweeps, divergence. Now let's make it practical. Can you walk us through a couple of specific step-by-step examples of how a pro might use this trading futures, like the ES or NQ?
Absolutely. Let's start with a defensive setup. Trading the support bounce.
Okay, bounce implies a ranging market.
Typically, yes.
Right.
This works best in a balanced or range-bound day. First step, context. You need to identify a key potential support level. A great place is often a high-volume node, an HVN, from your market or volume profile.
Where price spent a lot of time before, where value was agreed upon?
Exactly. So, step 2. As price comes down towards that HVN support level, you switch your focus entirely to the order flow tools. You're watching the tape and the footprint chart intently. You're looking for that absorption signal we discussed. You want to see aggressive sells hitting the bid at or near the HVN, maybe some large prints. But crucially, the price holds firm. You see size printing on the footprint at the bid side, but the price doesn't drop below the HVN.
That confirms the big passive buyers are defending that value area?
That's the confirmation. The absorption tells you the buyers are active and defending.
Well,
Once you see that, then you might consider entering a long position, placing your stop just below the absorption zone. You're trading with the confirmed defense.
okay, that makes sense for defense. Now flip it. Let's talk offense. Trading breakouts. More for trend days.
Usually, yes, on days where the market feels directional. Here, the focus shifts from high-volume areas, HVNs, to the opposite, low-volume nodes, or LVNs.
The thin spots on the profile where price didn't trade much before, less friction there.
Exactly. LVNs represent areas of perceived unfair value and, crucially, thin liquidity. Price can move through them very quickly. So the setup is, price approaches an LVN from below for a breakout higher. Step 2. Watch for a sweep. You need to see a fast sequence of aggressive market buys hitting the tape, lifting the offer rapidly as price enters the LVN.
Not just one big print, but a series.
Ideally, yes, a series of strong prints, maybe increasing in size and speed, confirming real momentum is building. You see this happening right through the LVN.
That's the trigger.
That's your signal to potentially jump in long, anticipating a quick continuation move through that low friction zone. You'd likely use small initial size, because these moves can be fast, and place your stop below the entry point within the LVN. You're riding the confirmed momentum through the path of least resistance.
Absorption at HVNs for bounces, sweeps through LVNs for breakouts. What about something more predatory, like playing stop runs?
Ah, yes, fading the stop run. This is more advanced, definitely requires quick reads.
Because stop runs are designed to look like breakouts, right?
They are. The setup is identifying a very obvious level where retail stop-loss orders are likely clustered. Just below a recent swing low or maybe under a big round number, you can often see thin liquidity on the DOM there.
Everyone knows the stops are there?
Right, so step 1.
Yeah.
Watch that level like a hawk. Step 2. You anticipate a quick, sharp move down to trigger those stops. You'll see it on the tape, a swift sweep, maybe some big sell prints as the stops cascade.
Okay, the stops get hit. Then what?
This is the crucial part, step 3. You need to see immediate signs of absorption right after the stops are triggered. The price pushes through the low, takes out the stops, but then instantly finds big buyers stepping in to absorb all that forced selling from the triggered stops.
So the big players push it down to grab liquidity, then flip.
That's often the game. They trigger the weak hands out, absorb the flow, and intend to reverse the market. If you see that sharp stop run followed immediately by strong absorption prints on the other fade, that's your signal to consider fading the move, entering long, betting on a reversal now that the stops are cleared.
Wow, order flow is the only way you'd see that flip happen in real time before price snaps back.
Pretty much. It gives you that inside look at the absorption after the stops are run.
Okay, these examples are powerful, but this sounds intense. High speed. It feels like risk management must be absolutely paramount.
Non-negotiable. Ironclad rules are essential.
What are the key takeaways there?
First, As a general rule, you want to trade with the flow, not fight the tape constantly. Don't try to pick tops or bottoms unless you have that really clear, multi-layered confirmation we talked about.
Like delta divergence plus absorption at a major level.
Exactly. Don't just guess. Second, patience. Always start with small initial size. Let the market confirm your read with more prints, more flow in your direction, then consider scaling in. Never risk significant capital on a single tick or a single signal.
Confirmation is key.
And third, context. Order flow is powerful evidence, but it's not the whole story.
Right.
What's the bigger picture? What's the higher time frame trend doing? What does the overall session profile look like? Is there major news coming out? That framework comes first. Order flow is your final trigger and confirmation within that framework.
Makes sense. And one final warning, seems like manipulation is a real risk here too.
Absolutely. Because this data is somewhat visible, you will see things like spoofing large orders flashed on the DOM to scare people, then pulled instantly, or fast algos creating misleading prints.
So how do you guard against that?
Look for sustained flow. Look for patterns that persist, not just one giant print that might be an anomaly or manipulation. You need confirmation over several ticks, several seconds, sometimes longer, before committing serious size based on the flow. Consistency matters.
Okay. So bringing it all together then, what's the main takeaway for someone listening?
I'd say the main takeaway is that order flow analysis gives you this crucial layer of transparency that simple price charts just can't provide.
Seeing how trades happen.
Exactly. By understanding who the aggressors are and who the passive participants are, you can start to identify critical moments. When aggression is clearly running out of fuel, that's your delta divergence or absorption signals. Or when powerful, undeniable momentum is taking control, that's signaled by those sweeps through liquidity voids. It's about reading the intent behind the price moves.
But let's be realistic too. It's not a magic bullet, right? There are limitations.
Oh, absolutely. It's challenging. For one, not all liquidity is visible on the DOM. You have hidden orders, icebergs, where only a small portion shows while a massive order sits underneath.
So you might see absorption without seeing the huge size on the DOM beforehand.
Correct. Also, latency is a factor. The big institutional players and high-frequency trading firms see this data and react fractions of a second faster than most retail traders can.
So it's a skill. It takes serious screen time practice.
Definitely. Many pros start by using replay features in their software to just watch the flow over and over, training their eye to spot these patterns without the pressure of live trading. It takes time to develop the feel.
Right. Practice and skill are needed to really read the intent.
And that leads to maybe the final provocative thought for you to consider. If order flow is about reading intent and it takes skill, the market often communicates its next real move, not just through price changes, but through the urgency and volume of orders that fail to move the price like absorption.
The failed attempts are the signal.
Often, yes. Which raises this question. In today's market, dominated by incredibly sophisticated and fast algorithms, how much of the visible order flow data do the really big players actually want you to see clearly? And could it be that sometimes the clearest, most obvious signals you see in the flow are actually designed to be traps? Something to think about next time you see a key level holding firm against seemingly overwhelming pressure. What's really going on beneath the surface?